You clicked this video because you are ready to start investing and you want to know what to buy. But here is the hard truth. The most dangerous thing you can do right now is put 100% of your new savings into passive funds immediately. You might think you are being disciplined, but you are actually accepting a hidden opportunity cost that could silently degrade your lifetime returns. By the end of this explanation, you will understand a dynamic allocation strategy that protects your capital from market peaks without requiring you to pick individual stocks. Let us start with the foundation. Before you worry about how to allocate your money, you must ensure your financial infrastructure is stable. Think of your financial life like a building. If the foundation is cracked, no amount of interior design will keep the structure standing. The research is unequivocal on this point. High-interest debt, often carrying rates of 20% or more, represents an opportunity cost that far exceeds the expected return of any passive fund. You cannot build a wealth portfolio on a shaky foundation. If you are carrying credit card debt or high-interest loans, the mathematical priority is to eliminate that liability first. The return you get by paying off a 20% interest rate is guaranteed and immediate. Any investment strategy you consider later is moot until this liability is resolved. Once your emergency fund is established and your high-interest debt is gone, you face a new challenge. The standard advice is to invest everything you have right away. This is called lump sum investing. The logic is sound on paper because the market generally goes up over time. However, this approach treats volatility as a uniform risk. It forces you to enter the market at a single, static price. If that price happens to be at a local peak, you are immediately exposed to a downturn. This creates a single point of failure in your portfolio. A market drop right after you invest can permanently degrade your compounding trajectory because you have no capital left to buy at lower prices. This is where the concept of time-weighted averaging changes the game. Instead of treating volatility as a uniform risk, we treat it as a variable that can be managed through a dynamic entry strategy. Imagine you have $10,000 to invest. A lump sum approach puts all $10,000 in today. A dynamic approach splits that capital. You might deploy a core portion immediately, say 60%, to capture the market's upward drift. Then, you schedule the remaining 40% to enter over the next 12 months. This is not market timing. It is not about guessing when the market will go up or down. It is about smoothing your entry price to reduce the variance of your results. Quick resource note. I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. This strategy functions as a risk management architecture, similar to circuit breakers in distributed systems. It prevents the system from crashing when a shock occurs. By deploying capital systematically, you avoid the psychological barrier of fear that often paralyzes investors. When the market drops, you do not panic. You have scheduled capital waiting to be deployed at a lower price. This turns volatility from a threat into an opportunity. You are effectively buying more shares when prices are low without needing to make a conscious decision to do so. Now consider the mathematical impact of this approach. The miracle of compounding is highly sensitive to the timing of capital deployment. A time-weighted entry strategy optimizes your compound annual growth rate by reducing the impact of sequence of returns risk. This means that over a 10 to 20-year horizon, your geometric mean return can be higher compared to a binary all-in approach. You are not trying to beat the market. You are trying to ensure that a bad entry point does not ruin your long-term results. This decouples allocation logic from market timing, allowing for a hands-off, automated execution model. You do not need stock-picking skills. You simply follow a predetermined schedule. There is a common misconception that this requires constant monitoring or complex analysis. That is not the case. You can set this up once and let it run. The key is understanding that this is a sophisticated alternative to blind lump sum investing. It acknowledges that the market is volatile and that entering at a peak is a real risk. By using a dynamic approach, you are essentially saying that you value the safety of your capital as much as you value the potential upside. You are building a portfolio that is resilient to the inevitable ups and downs of the market. However, implementing this strategy does require a bit of rigor. You need to perform a cost-benefit analysis of your specific financial situation. You must calculate how much of your capital you can afford to deploy immediately versus how much you need to reserve for future entries. This is where the engineering principle of smoothing input noise comes into play. Just as an engineer smooths out signal noise to get a clear reading, you smooth out your investment noise to get a clearer return profile. If you do not have the capability to model these scenarios, you might stick to a simpler dollar-cost averaging plan where you invest a fixed amount every month. The principle remains the same. You are spreading your entry over time to mitigate the risk of entering at a peak. The evidence suggests that while standard advice advocates for immediate passive investment, data-driven approaches reveal that dynamic allocations can mitigate risk without requiring active stock-picking skills. This is not about finding the perfect stock. It is about optimizing the timing of your entry into the market. It is about recognizing that your entry price matters. It is about understanding that volatility is not just a risk to be feared, but a variable to be managed. By adopting a core satellite or time-weighted strategy, you are building a more robust financial system. You are acknowledging that the market is unpredictable, and you are preparing for that unpredictability. The primary barrier for many investors is the belief that they need to know everything to start. They wait for the perfect moment, or they wait until they have mastered complex analysis. But the truth is, you do not need to be an expert to improve your outcomes. You just need to change your approach from a binary all-in strategy to a dynamic allocation plan. This shift allows you to participate in the market's growth while protecting yourself from the worst-case scenarios. It is a practical, evidence-based way to invest that respects the complexity of the financial world. The hidden opportunity cost of putting 100% of your savings into passive funds immediately is the risk of entering at a peak. This is a risk that time-weighted averaging can significantly reduce. By adopting a dynamic entry strategy, you are not just investing money, you are managing risk. You are building a portfolio that can withstand the volatility of the market without sacrificing long-term growth. This is the difference between a portfolio that is fragile and one that is resilient. It is the difference between hoping for the best and preparing for the worst. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.